Good morning, everybody. It's Monday. I was looking at the chart of the US dollar index over the weekend, currently testing a support level going back quite a long way, a trend line. And I'm going to show you on the euro US dollar chart, because the euro is the most heavily weighted currency against the dollar. So basically it's a mirror image of the dollar index. But before I go there, I'm just going to remind you about how the dollar is actually recovering against some currencies. We looked at the Aussie US quite a few times last week because it was just such an important trade as we were hitting longer term trend line resistance and the 200-week moving average just below the 23.6% fib. And I suggested that despite the fact that we have been in a very strong bull trend since April, that the market might reverse. I'm happy to say that did actually happen. Bang on the trend line, bang on the 200-week moving average, the market's reversed. Long upper wick on the candle, a red body, so a high test candle, a shooting star, whatever you want to call it, and a close around the halfway point of the previous week's strong green candle. So that's pretty negative, and I think it does indicate that there is a strong chance that the Aussie versus the US has reversed and will resume its longer-term bear trend since February 2021. A 4.5-year bear trend that we are resuming. And this is why you have to look at longer term charts, because of course if you were just looking at the daily chart you would think we are in a really nice bull trend when we're actually in a longer term bear trend. Look, here's the daily charts just in case you missed my videos last week. There you go, you'd have seen this lovely V-shaped recovery and then strong bull trend since April, but now we are reversing and resuming a longer term bear trend. Right, now the important thing here is, if we're going to analyze the dollar, is to see the euro versus the US dollar, because the euro has the heaviest weighting in the dollar index. So when you're looking at the dollar overall, a lot of what you're looking at is the euro versus the US dollar. I hope you follow me on that. Monthly chart. Again, we have to look at the longer term charts. Whoa. Now this chart goes all the way back to 2008. So I'm sure some of you will remember the global financial crisis when the dollar tanked, euro rocketed, and then the market reversed. So we're looking at this whole bear trend for the euro versus the US dollar, this US dollar strength since the global financial crisis. That is 17 years. Wow, that went quick. 38.2% Fibonacci resistance is at 120.11. We got pretty close. We got to 119.17. Okay, so we got to within 100 pips, 1 full point of that 38.2 Fibonacci resistance in the month of September so far. Pretty close. That's well within the margin of error. 200-month moving average. So it's a really, really major moving average. The red line there coming in just under that 38.2% fib, just under 120. A lot of resistance. So all the smart traders out there looking at their longer term charts have seen it and got into short positions or got out of their long positions a little bit early. They didn't want to wait for that 120 level to get hit. They wanted to get out. Now, when we look at the weekly chart, you can see another high test. We shot up to 119.17 and then reversed, closed the week almost unchanged, leaving a long upper wick, high test bar indicating that aggressive selling came in. Now, if you weren't looking at your longer term charts, if you were only looking at your daily chart, you might be confused, because if I go to the daily chart, you will see that we've broken out of a pattern. Pretty bullish. We were consolidated for quite a long period of time. We broke above the upper trend line of a triangle consolidation pattern, the downward sloping upper trend line. Bit confusing, but you know what I'm saying. And we pushed higher. And if you were a bull, you'd be jumping into long positions here and thinking, right, here we go. I'm going to run this position. We could have some serious upside here. That is why the market turned around. If you're looking at the euro US dollar and you're thinking, why is it turned around? The dollar should be weakening because we've just had a rate cut. We've got projected future rate cuts, probably 2 more this year. We've got falling employment rates. We've got rising unemployment rates. We had a revision to the 12-month unemployment rate, which was higher by something like 1 million, I think it was. I mean, there is a lot of potential weakness in the US economy, and you might be thinking to yourself, it's about time the dollar took a dive. Well, perhaps not. Perhaps the dollar will actually do the opposite. Perhaps the dollar will rise. Maybe there are just too many dollar short speculative positions out there and they're about to get squeezed. So we'll see if I'm right this week, but these are my reasonings behind it. We'll just remind you, 1 month chart going back to 2008. We have just rejected the 23.6% fib at 120.00, the 200-month moving average. And even on the monthly candle, we've got a high test bar. The weekly chart is showing that bearish candle, which for me is good enough confirmation that that resistance level is working. I'm not saying we won't turn around and go back and retest it. We might, but just have it in your head that 119.00, 120.00 is a very, very important resistance level in the euro. And all these people who bought on the breakout of the triangle consolidation pattern might be about to get themselves in a lot of trouble. So on the daily chart, that red candle, high test, red body, and then we've been sinking ever since. My Fibonacci levels can give us some sort of idea of where we can go on the downside. 23.6% Fib is around 115.00, so that's about 250 pips below where we are now. Maybe we'll make our way down there. I don't know the speed of the move. I don't know the timing of the move. We have got a lot of congestion here in this structure in the euro US dollar, so we may just hover around here on the way down. I'm not in the prediction game. I'm just in the support and resistance game and trend following, and I just think that there is a very strong chance that the trend may be changing. Now, one thing I will say, in my 20 to 25 years experience of technical analysis, markets don't tend to do upside down V-shaped moves. I'm not saying that it won't happen, but I would be surprised if this market simply turns around and collapses. This particular rally started in February of this year, and I don't think it will necessarily turn around and move down at the same pace. I think we would need to see something of a reversal pattern before we get an acceleration to the downside. Now, I don't know what that might be. We might get a small double top. This might be the left shoulder to a head and shoulders pattern. We might come down to 23.6% or just below. This probably bounced because of the 100-day moving average. Now, the 100-day moving average is a little bit higher at the moment, so we may not come and retest this low that we saw at the end of July, beginning of August. We might have a higher low, but then we might put in a lower high. Does that make sense? We might bounce off around somewhere around the 23.6% Fib. Then we might put in a lower high around 117.5, something like that, and then form the right shoulder, break below 115.00. That would be then the formation of a head and shoulders pattern, and then we would collapse. Okay, I'm looking weeks into the future for this, but what I'm just trying to say to you is jumping into a short position blindly might not be the right strategy. We have to wait for signals, patterns, trends to develop. Okay, I hope that is clear. This could be one of the most important turning points for the US dollar of the year, and it might really create a squeeze if there are as many speculative short dollar positions out there as I think there probably are. Okay, hope that's helpful. Please do join me tomorrow and we'll find some more trade ideas for you.